like to introduce Chris McAlpine, who is the co-founder of Context Capital, who we at Securitas have engaged as our asset consultants. Most recently, Chris was the Senior Investment Analyst at WA Super. Today, Chris will be giving us an investment performance overview of our separately managed account models.
In what has been a very challenging start to 2022, inflation and interest rates, geopolitics and supply chains have been the driving force behind market movements in the first half of the year. When we combine these factors with the historically low starting points for interest rates that were a result of central bank action coming out of the COVID crisis, the result has been a market where both bond and equity markets have sold off at the same time, which has led to one of the most severe destructions of financial wealth since at least 1980. The chart that you're looking at now shows, in dollar terms, how much wealth has been lost as a result of the share and bond market crashes since the beginning of this year. Note the steep drawdown in the line at the right, which shows that about $15.5 trillion, or roughly 60% of US GDP, was lost as a result of market drawdowns to start the year. None of the factors I mentioned above look set to ease in the near term, which could make for a turbulent second half to the year as well. While central banks in the developed world have begun rapid interest rate tightening cycles, inflation remains stubbornly high. This is true across the board for the OECD, a club of mostly developed rich world countries, and for structural reasons looks likely to remain the case in at least the short term. It is food and energy prices that are driving inflation higher for the moment, and for as long as the conflict in Ukraine persists, this is unlikely to change, since these are arguably the most difficult aspects of inflation to target with conventional monetary policy. The next two charts show some more insight into inflation data across the OECD. The first chart shows that, while overall inflation is quite a bit higher than we're normally used to, we see that it is primarily food and energy, as I mentioned before, that's driving the headline rises in inflation rates. The second chart shows the year-on-year inflation increase across the OECD club of countries. We see at the far right of the chart a sharp uptick in the line, demonstrating that we are currently seeing rates of inflation that we've not seen since at least 1990. Now, worryingly for central bankers, short-term inflation expectations seem to have come unstuck from their guidance, although for the moment, longer-term expectations have plateaued. This chart shows what US consumers expect inflation to be over the next 1 and 3 year periods. Looking to the far right of this chart, again we see a line that has increased sharply from recent times. This line indicates that people expect inflation rates to be significantly higher 1 year from now relative to where they are today, for the first time in several years. Higher inflation rates and expectations have forced central bankers to raise rates into an economic environment that is looking increasingly fragile even outside of inflation. In America, the bellwether for the global economy, consumer sentiment as measured by the University of Michigan survey is at an all-time low, exceeding even the GFC and COVID crashes. And despite the record stimulus provided during the COVID crisis, non-housing debt, so credit card debt, has reached all-time highs, which potentially indicates that any savings buffer that was built up during COVID, particularly for lower-income houses, may have run out. The blue line tracks US consumer sentiment through time. What this aims to measure is how people are feeling about their personal financial household situation and how they expect that to change over the next couple of years. We can see the far right of the graph, the blue line is at an all-time low, indicating that people are not feeling that confident about their personal financial situations. The next chart provides us with a measure of how much non-housing debt people are carrying in the US. We see that both the total level as well as credit card debt is currently sitting at or near all-time highs, indicating potential economic fragility to come. Turning to Australia now, similar economic indicators are looking slightly more robust. Australian consumer confidence surveys have declined for 7 straight months, but remain slightly above levels from COVID or the GFC, and credit card balances are healthier than they were pre-COVID in Australia. The next two charts show Australian consumer sentiment surveys as well as Australian levels of credit card debt. While Australian consumer sentiment has ticked down from a recent high at the end of 2021, the overall level remains near historical averages. Turning to Australian levels of credit card debt, we see that these have actually come down post-COVID and remain at average levels relative to historical norms. Turning to share markets specifically, rising rates, consumer sentiment, and geopolitical factors, all of these have helped to contribute to steep equity market declines to begin the year. As the market segment most exposed to interest rate risk, tech stocks continue to lead the decline in terms of sectoral impact, while from a geographical perspective, the US and Europe have been hit hardest relative to Australian markets. The following chart shows share price declines for selected markets to start 2022. We see that Australian markets have held up relatively well compared to some others, being down just over 10%. This compares with declines of between 15 and 30% for world and US markets. Turning to bond markets now, central bank action, in attempting to bring inflation under control and raising interest rates, has led to material sell-offs in fixed interest markets. Historically low rates post-COVID meant that bond indices had built up considerable duration risk or sensitivity to rising interest rates. As banks have raised their policy rates at the fastest pace in decades, bonds have correspondingly sold off. The following two charts show the policy cash rates for central banks in America and Australia. Looking to the far right of either chart, we see that recently banks have begun to sharply raise these cash rates. The result of these rising rates has meant that two widely tracked indices across Australian and global bond markets are down significantly on the year, both by around 9.5% between January and the end of June. Other sectors of the fixed interest market have also come under pressure, including lending to companies. As cash rates and therefore lending rates rise and the general economic outlook deteriorates, corporate credit has come under pressure. A broad measure of lending to companies has fallen by 13% over the calendar year to June. Turning now to other asset classes, some diversifying strategies have had strong performance both in relative and absolute terms over the duration of the sell-off to start the year. Ruffer, a real return fund included in Securitas's portfolio with a contrarian and inflation-linked bent, has performed particularly well. While 2022 has been a challenging time for investors, we are optimistic when we look forward. The recent sell-off in equity markets mean that shares are now more fairly priced, and so our return expectations relative to where they were 6 months ago have actually increased. It's a similar story in bond markets. While rising interest rates have caused the value of existing bonds to drop, moving forward, what it means is that bonds will pay higher interest rates, meaning that income will be higher and our forward-looking expectations for what bonds can provide is also higher as well.